Welcome back, everyone. Okay, today we have a financial mystery that is seriously going to bend your mind. Have you ever wondered why, even when the stock market or some hot new investment boasts this fantastic average return, so many regular, everyday investors still end up losing money? Well, we're going to unpack a mathematical trap that literally catches even the smartest people totally off guard. It's this crazy phenomenon where the math says you should be getting richer, your expected value is totally positive, but your bank account just keeps getting smaller. Grab a notebook because what we're looking at today in this explainer is going to fundamentally change how you view risk, averages, and your own money. Okay, let's dive into this. Imagine I invite you onto a game show and I offer to let you play a game with your own cash. I promise you, mathematically, this game will make you 13.3% richer every single month on average. Just think about that for a second. I mean, in the real world, getting a 13% return in an entire year is considered a massive victory, and I am offering it to you every single month. Your brain probably immediately goes, sign me up. Over time, I'm going to be a millionaire. But hold on to your wallets, because this is exactly where the trap begins.
Section 1. The Perfect Investment Trap. Let's look at the setup.
So here are the rules of the game. Every month, you put your money in, and we spin a big wheel that's split evenly into 3 slices. If it lands on the first slice, you instantly double your money. That's a 100% gain, meaning your money is multiplied by 2. If it lands on the second slice, absolutely nothing happens. You keep your money exactly as it is, it's multiplied by 1, and if it lands on the third slice, you lose 60% of your money, meaning you're left with just 40% of it, multiplied by 0.4. Now, if you're holding a crisp $100 bill right now, think about playing this game. You literally have a 2 in 3 chance of either doubling your cash or just staying completely safe. Sounds like an amazing deal, right? Let's do the simple math you probably learned in middle school. Imagine 3 parallel universes. In universe 1, your $100 becomes $200. In universe 2, it stays $100. In universe 3, it drops to $40. If you add up the results of those 3 universes, 200 plus 100 plus 40, you get $340. Divide that total by 3, and your average result is $113.33. In math class, they call this the expected value. Here, your expected value multiplier is greater than 1. It's 1.13. It looks like an absolute mathematical guarantee that you are going to get rich.
Section 2. The 2-year math shock. Fast forward a bit.
Prepare yourself for this massive twist. After 2 years of playing this game, 24 months of a game that mathematically guarantees a 13.3% average monthly gain, a staggering 70.3% of players will have actually lost money. Let that sink in for a second. More than 7 out of 10 people who participate in an investment with a strongly positive expected value walk away poorer than when they started. It feels completely impossible, right? Like a glitch in the matrix. And honestly, it gets worse. Let's look at the median outcome. The median basically means if we lined up all the players in a giant gymnasium, from the absolute poorest to the absolute richest, and we walked right up to the person standing exactly in the middle, that typical middle-of-the-pack player watches their original $100 completely evaporate down to just $16.80. Half of all the people playing end up with less than 17% of their starting cash. How is there such a massive disconnect between a winning average and the reality that it destroys over 80% of a typical player's cash? Make it make sense.
Section 3. Multiplication versus addition. Time for some detective work.
And this brilliantly illustrates exactly where we go wrong. Our brains are totally wired for addition. The myth we tell ourselves is plus 100%, plus 0%, minus 60%. Hey, that leaves me with a positive 40%. But investing isn't addition. It is sequential multiplication. Your money compounds based only on what is left over from the previous round. Let's trace it carefully. Start with $100. Double it, you have 200. Next month, multiply by 1. Still 200. Third month, you hit that bad slice and lose 60%. Multiplying 200 by 0.4 leaves you with $80. Look at the reality. 2 times 1 times 0.4 equals 0.8. You hit one of each outcome, and instead of gaining wealth like the average promised, your expected value completely failed you. You actually suffered a 20% loss.
Section 4. Why big losses destroy.
This right here is the brutal, asymmetric truth of math. If you lose 60% of your money, a 60% gain does not get you back to where you started. Let's use our $100 bill again. If you lose 60%, you're down to $40. To get from 40 back up to your original 100, you need to make $60 in pure profit. Well, 60 is 1.5 times your current $40 bankroll. That means you need a monumental 150% gain just to get back to zero.
You fell down a 60-foot hole, but you have to climb a 150-foot ladder just to see the sunlight again. So, the crucial point is this. In the world of multiplication, one single crash has the destructive power to completely wipe out multiple huge wins. You could spin the wheel, double your money, double it again, feel like an absolute genius, and then one unlucky spin of a 60% loss brings your entire compounding snowball to a grinding halt. Mathematically, avoiding large losses is vastly more important than chasing big, spectacular gains.
Section 5. The secret of averages. Because the obvious question still remains. If the math is so heavily stacked against the typical player, why did the average tell us we were making 13.3% in the first place? Who is making all that money? Well, imagine 10 people playing this game. For the average to be positive, you don't need everyone to win. You just need one lucky extreme outlier. Imagine 9 people play the game and end up with $10,000 left. But one person gets absurdly lucky. They hit the double your money slice of the wheel 15 times in a row. They finish with $10 million. If you add up all their wealth and divide by 10, the average player has over $1 million. It's like one kid scoring 1,000% on a test and ruining the grading curve for the whole class. It's a complete lie for the normal person. The arithmetic mean gets violently skewed by a tiny handful of extreme lottery ticket winners, leaving the rest of us in the dust. So, how do we find the actual truth? Enter the geometric mean. Think of this as our ultimate forensic tool, the real truth teller. While the regular average just lumps everyone's money together, the geometric mean calculates the actual step-by-step reality for a typical person as their money multiplies over time.
Now, what's really interesting here is when you apply the geometric mean to our game show, the mathematical reality is completely exposed. We multiply our 3 outcomes, 2 times 1 times 0.4, which gives us 0.8. Because there are 3 spins, we take the cubed root. In super simple terms, we just ask, what number multiplied by itself 3 times equals 0.8? The answer is 0.928. That means the typical player isn't making 13.3% at all. They are experiencing a monthly loss of 7.2%. This compounding friction perfectly explains why our median player ended up with only $16.80.
Section 6. How to play it safe. Let's bring this to the real world.
If you want to actually survive the math of investing in the real world, you absolutely have to follow these rules. First, you must avoid devastating big losses. A 60% drop destroys the math of compounding, plain and simple. Second, realize that high expected averages do not mean safety. A stock market or a crazy new crypto asset might brag about a high historical average, but if the volatility, the wild swings up and down is too high, the typical investor will still lose everything. And third, manage your risk. Don't go all in and put all your eggs in a basket that routinely suffers massive drops. You have to diversify so that no single 60% loss can drag your entire portfolio down the multiplication drain.
It all really comes down to this. Smart investors don't just chase high averages. They focus on surviving the big drops. In the game of long-term wealth, survival is actually the highest form of performance. If you can just stay in the game and avoid the mathematically crippling zeros, compounding will eventually work its magic for you.
And that brings us to the end of our explainer today. I want to leave you with this final crucial thought. Next time a friend, a broker, or a flashy ad offers you an investment with a can't-lose high average return, will you remember the game show? Will you stop and ask about the geometric mean, the actual volatility, and the hidden math underneath? I really, really hope you do, because knowing the difference between addition and multiplication might just save your life savings. Thanks for joining me on this deep dive. Keep asking the smart questions, and I'll catch you on the next explainer.